Hey guys, Jim Cramer just revealed that everything is finally lining up for Tesla. But why does he think so? What exactly is in the pipeline for the EV giant? Well, keep watching as we unveil Tesla's massive plans. Now, Tesla officially opened its new German electric vehicle plant on March 22nd as the company aims to diversify manufacturing outside of the US and China. Following the news, Jim Cramer said everything is lining up for Tesla at just the right time. So for starters, this is one of the many reasons Tesla will experience an upside. That's why Jim Cramer thinks Tesla stock is about to have a big run. He highlighted analysts' expectations that Tesla will reach an overall run rate, allowing it to produce about 2 million units by the end of the year. Cramer said that Tesla also seems to have figured out how to handle supply chain constraints better than the competition. He believes that the ribbon-cutting ceremony at Gigafactory Berlin on March 22nd represents the de-risking measures the company is taking in relation to China. In a nutshell, Jim Cramer believes that with Giga Berlin already running, things will positively change for Tesla. And just like Cramer, there are analysts who also believe that Giga Berlin is a game changer for Tesla. Now, one thing that Tesla has done consistently well over the past several years is beat Wall Street's predictions. And according to Wedbush's Daniel Ives, a similar story is taking place right now. Based on the current demand trajectory for Tesla that we're seeing so far in the March quarter, unit deliveries are trending well ahead of street expectations. Sales in China and Europe in particular are charging ahead of street estimates by at least 15%. Add into the mix US Model Y-driven strength, and it's not out of the realms of possibility that by the end of 2022, Tesla will be on a 2 million unit run rate. On top of that, coinciding with the recent opening of the flagship Berlin factory, there has also been incremental Model Y strength in Europe over the past few months. In fact, Ives considers cutting the red ribbon on the Berlin factory as a bit of a game changer which will address prior supply issues. The Berlin factory establishes a major beachhead for Tesla in Europe, with potential to expand this factory to production of 500,000 vehicles annually with Model Y front and center over the coming 12 to 18 months. Well, the pivot to EVs was already taking place, but EV makers also stand to benefit from the macro developments which have seen oil and gas prices rise significantly. This especially pertains to Europe, even more so now as it looks to address its dependence on Russian energy, with the race for electrification in Europe hitting another gear. With Russia, the country that produces the most crude oil, which is also the primary ingredient for gasoline at war, gas prices can be expected to stay elevated for a lot longer. Moreover, it's almost certain that many countries will be reducing their energy dependence on Russia. If that happens, gas prices will naturally go up as other suppliers have to cope with a sudden rise in demand. Additionally, consumers who had previously been on the fence regarding EVs are likely to consider transitioning. And while Ives notes that the competition is increasing from every angle, the clear leader of the EV pack, Tesla, should be the prime beneficiary of this development. As such, Ives views the Giga Berlin as a major competitive advantage for Tesla to further build out its supply footprint in this key region. He expects component shortages to ease next year, allowing Tesla to better meet growing demand in China, while new factories in Austin, Texas, and Berlin should alleviate global production bottlenecks. Ives also thinks Tesla stock has been the victim of the risk-off mentality among tech investors, with the shares now way oversold. That said, according to the analysts, the street has recently started to better appreciate what the seminal launch of Giga Berlin means for the Tesla supply story in 2022 and beyond. To this end, Ives maintains an outperform rating for Tesla shares along with a $1,400 price target. Should the figure be met, investors are looking at one-year returns of 29%. We'll talk about Tesla hitting an upside soon, and that's just what investors are looking forward to. So we're going to analyze Tesla stock's recent performance and determine if the upside is already in motion or investors should wait a bit longer. So on March 28th, shares of Tesla gained strong upside momentum after the company stated that it wanted to have a stock split in the form of a dividend. Now, what does that mean? A stock split will make the stock more affordable for retail investors. At a current price of almost $1,100 per share, Tesla stock is too expensive for many retail portfolios. In a separate announcement, Tesla said that it would suspend production at its Shanghai factory due to the lockdown in the city. Fears about lockdowns in China have already put material pressure on commodity markets, and it remains to be seen whether the factory will be able to get back to work this week, as such a big decision would depend on the coronavirus situation in the area. With that said, what's next for Tesla stock? Tesla's stock split proposal must be approved by the board and the shareholders at the company's annual meeting, but there's little doubt that it would face any problems. Analysts expect that Tesla will report earnings of $10.61 per share in the current year and $12.92 per share in the next year. So the stock is trading at 84 forward P/E for 2023. It should be noted that analysts' estimates have been moving higher in recent weeks despite supply chain problems and the recent rally in commodity markets. Meanwhile, the stock rallied from $700 to the $1,100 level, and the stock split news served as an additional positive catalyst for the strong rally. Well, Tesla stock has historically traded at high P/E multiples, so traders will likely ignore valuation concerns and focus on the upcoming stock split and the dynamics of demand for riskier assets. The recent rally in Treasury yields didn't put any pressure on Tesla stock, but higher yields may ultimately serve as a negative catalyst for growth stocks, so traders should keep a close eye on the developments in U.S. government bond markets. The almost certain outcome, however, is that the Tesla stock split will make shares more accessible to retail investors who currently balk at the four-figure sticker price. It's true that brokers are happy to sell their clients fractional shares for free, but a stock with a high dollar price is simply tougher for traders, investors, and insiders to sling around. Slicing the price of admission to any stocks helps increase liquidity and volume. Those aren't necessarily bad things, just be aware that volatility will likely increase as a result too. Now, the downside to stock splits is that a company's stock usually goes up even though nothing under the hood has changed. A stock split is essentially the same thing as making change. Let's say swapping a bigger bill for smaller equal bills. But a company's fundamentals, its prospects, and its shares valuation remain the same. So Tesla stock might still be a risky buy in the short term due to the market's uncertainty. However, in the case of a market crash, Tesla will still inevitably recover. If a recession does not occur in the near future, the stock will likely reverse trends due to rising gas prices and soaring sales. But one certain outcome is that in the long term, it can return a lot of profit. Wedbush's Ives estimates that by the end of 2022, Tesla will have capacity to produce about 2 million cars annually from around 1 million today. Remember that Giga Berlin is already up and running. If the Berlin plant hits the 500,000 mark a year in deliveries, then Tesla will certainly return massive profits. So basically, we have to wait and see how the new factory will perform. Okay, so that's it for today. If you enjoyed the video, remember to like, share, and subscribe. Stay safe, and we'll see you next time.